Should you pay off your student debt before purchasing a home, or is it something you can totally do while you have student debt?
Hi, I'm Delaney. I am your millennial home buying agent here in beautiful Boise, Idaho.
Whether you are a first-time homebuyer, looking to upgrade, or considering an investment property, my goal is to provide you with all the knowledge and tools you need to make an informed decision about home ownership.
On this channel, you will get everything from market updates to home buying tips, tricks, and everything I know. You are also going to get information on how to maintain your current residence. Or are you interested in investing in a real estate property? I've got everything you need right here.
Boise is an incredible place to live, work, and play. I can't wait to share all the hidden secrets and gems with you. So if you're ready to embark on your home ownership journey, hit that subscribe button and let's explore the Boise real estate market together.
The myth that we are going to be busting today is that you should not buy a home while you have student debt, or that you can't even buy a home while you have student debt. Truth is, there are specific loan programs out there that allow for even like doctors who have way more student loan debt than the normal person to still purchase a home. So just because you have student debt doesn't necessarily mean you cannot purchase a home. It does usually mean that there is less money in the bucket for down payments, for your mortgage payments, things like that, but it does not stop you from purchasing a home. While I understand a lot of people grapple with the idea of paying off their student debt prior to purchasing a home, and yes, that can be something that you can do. However, I don't want you to think that is your only option when looking to purchase a home, especially if buying a home or the right opportunity comes up while you still have student loan debt. Sometimes things happen and we still have some debt that we're paying off, and working with the right lender will actually help you understand what you can afford while still paying off your student debt. So how does a lender look at that debt, and how does that affect you when going to purchase a home? So first, your lender is going to look at your DTI. DTI, debt to income ratio. Now, this ratio, they usually like to see under a certain threshold. Most lenders want to see your DTI as low as possible. So a lot of financial experts will say to keep your DTI between 33 and 36% of your income. Well, that's not always realistic. Life happens, we have debt. It's just part of life. Now, I'm not out here recommending that you work outside of your means. However, there are situations that do allow for you to go over that 36% ratio, and it is okay as long as you as an individual feel confident with that number and that monthly payment within that kind of boundary. Most lenders will stick to a 28-36 rule. So what is that rule and how can we read that? So the 36% is going to be things like your principal, your mortgage insurance, the interest, property taxes, and it's going to include any other debts that you might have, which include credit card debts. They're going to include your car payment. They're going to include your student debt. So all of that needs to stay within about 36% of your income. The 28 part of that rule is going to be your housing costs that need to stay about 28% of your income. And so these are still the things that we talked about, but they only have to do with your housing. So it's going to be your principal, your mortgage insurance, your property taxes, all of that. You want that to be about 28%. So you're going to have a 28%, which is just housing. And then that feeds into your 36%, where your 36% is all of your debt that you have accumulated. Just remember that that 28-36 rule has nothing to do with your credit score. This is strictly the amount of debt you've accumulated or are looking to take on, and to make sure that you are not overstepping. We don't need to go back to 2008, 2009, where lending rules were so vague and so lax that you could assume debt way more than you needed to, which caused us to go into a housing crisis. So therefore, they have tightened up some of those lending requirements that we don't put people in situations that they can't afford and they don't realize they totally can't afford it. So let's talk about lowering your DTI. How can we lower it to make things a little bit more comfortable for us in getting into that 36% DTI? So the first you can figure out is if your debt allows you to do graduated payments. So this is a great way to start with a lower payment in the beginning, and then typically every 2 years that payment has to increase to a larger amount. The idea with this is the fact that you are probably going to be getting promotions and making more money each year, so that the payments graduate up in amount by you also making more money each and every year. The next thing you can do is consolidate some of your debts. So this is a way for you to move your debt from one area to another and have a lower interest rate and therefore lowering the amount you have to pay every month. I would just be careful with doing this because if you do this too much, you open yourself up for potential of overspending and getting yourself back into that same hole. Some lenders will allow you to lengthen the amount of payment time that you have on your loan or your debt. So if typically you have to pay it back within 24 months, you sometimes are able to negotiate a 36-month or a 48-month payback, and therefore your payments will become lower because of the amount of payback time that you have. So that is another way that you potentially can lower your DTI. So what are a few other ways that you can lower your DTI that don't include changing kind of some of those terms on your loans and stuff like that? So the first is you can always get a side hustle, make a few extra $100 a month, pay that towards your debt, and that will help bring down your DTI because you are paying more onto those loans. You don't owe as much. The other is maybe selling your car, using public transportation if that's an option for you, or selling your expensive car and buying something that's cheaper, allowing you to lower your DTI. I've mentioned this before, but you need to shop around for a lender when you are looking for a home because lenders are all different. They all have different access to different loan programs. And some lenders will work with you if you have other debts, specifically student debt, and some lenders just won't even touch you. So shopping around, figuring out what the best program is for you and the best lender is going to save you and also put you in the right position. So you can also tap into federal loan programs. So this is, again, why it's a good reason to work with a really great lender who's willing to look at a lot of different loan options for you. So first, Fannie Mae allows up to a 50% DTI with 3% down. This is important for you to know and to ask your lender about. So the next is VA loans. So you can qualify for a VA loan with as much as 41% DTI if you qualify for that loan program, which meaning you have to have been in the military and qualify for a VA loan. FHA loans are also a program that allow you to have a higher DTI than necessary conventional loans. So you can have up to almost up to 50%, depending on your situation. Now, on your total DTI, so that what we were talking about as a 36%, could be up to almost 50% if you're using a FHA loan. You want to make sure with an FHA loan, obviously you have to qualify for it and everything like that. So don't put all your eggs into qualifying for an FHA until you have talked to a lender, because that's really important to make sure you actually qualify for the loan that you want to use and works with the DTI that you have. Are you actually ready to purchase a home? So this is something you need to make sure that you're financially ready for, because you do not want to be house poor. There are other expenses that come with purchasing a home, more than just your down payment and your mortgage. And these are really important to understand, because we don't want to put you in a financial place where you are so house poor that you actually can't enjoy the life that you have worked so hard for. As a first-time home buyer with student loan debt, you are going to need to lower your expectations for what you can actually afford. This is sometimes really heartbreaking for people who have friends who are out there purchasing homes, and they almost seem like dream homes for these individuals. And if you have student debt, you may need to purchase a home in more of the fixer upper stage and put some of that sweat equity into making sure that you are building equity in that home and not going outside of your means. If you're ready to talk about purchasing a home, but you aren't sure about student loan debt and stuff like that, please reach out. I'd love to chat with you. And if you are not in the Boise area, we can find a real estate agent in your area who can have these conversations with you. We'll talk later. Bye.